This is your March 2016 investment update. March was a great month for the equity markets, much needed after a tough start to the year. The S&P 500 was up 6.78% in just the month of March, which brought it green for the year. It's up 1.35% year to date through the end of March. International stocks rebounded as well. Those were up over 8% and have kind of pulled flat for the year. Bond markets globally are continuing to go up. The U.S. was up a little bit in March. International bonds are performing extremely well. So kind of everything rebounded and kind of brought us back to where we started the year, and it happened relatively quickly. The big news out of March was at the very end of February, the beginning of March, they had the G20 Finance Summit in Shanghai. And what this is the heads of all the global central banks and a lot of the big thinkers globally get together and talk. And there's been a lot of news that there was some sort of a accord or some sort of handshake deal that happened where global central bankers, including Janet Yellen and the Fed, might have decided to just kind of lay off and stop enacting all these policy measures. While we don't believe there is really a handshake deal, the Fed, when it comes time to raise rates, they're going to have to do it, especially if you get oil rebounding and you get some inflation. And given where our employment situation is, it's going to be time for them to raise rates, and we still expect them to do that twice this calendar year. We do think, and it has been reported, that central bankers have agreed to become more transparent amongst themselves. So if China needs to devalue their currency, instead of just doing it 3% on a Sunday afternoon like they did last August, which caused complete turmoil in the markets, they're going to begin to telegraph amongst themselves a little bit. What that does is take a lot of uncertainty out of the markets, and one of the number one things the market hates is uncertainty. You can't plan. You don't really know what to own if you're trying to guess what a central bank may or may not do. If there's going to be some kind of policy in action or you're hoping there's some inaction, it just becomes very confusing, and markets hate that. And so it seems that while nothing's really changed, China still has their issues, Europe still needs to weaken their currency to combat some deflation in the periphery, and we have a lot of the same problems we had in the end of February. What has happened is you've kind of taken a surprise central bank move off the table temporarily. And that's going to mean we're probably like the eye of the storm from this currency standpoint for the time being, and markets are going to be allowed to drift higher and kind of can move on from there. So we're going to stay tuned on all those issues. They haven't been fixed, and we do expect further volatility as we move into the summer. But things certainly are, and the markets are certainly a lot healthier looking today than they were 30 days ago. One of the other just kind of things we're noticing, the leadership in the market has completely changed. The worst performing stocks last year are now the best performing stocks this year. And what that means is value investing, which has been completely out of favor the last 3 years, is now getting new leadership in the market. And the way it looks, we expect that to continue, which is a good sign if you own good durable businesses and you've kind of shied away from big, high multiple growth stocks that have driven the markets the last couple of years. If you are investing with a margin of safety and investing in things that are a little bit cheaper and might have some more resiliency in all kinds of economic environments, those things seem to be leading the market higher, which is a welcome change from previous months.